When talking about rental income, you have your gross rents, you have your expenses, and what you're left with is cash flow. Hello everyone, my name is Jonathan, and in this video, I'm going to go over how to analyze properties looking at cash flow. This is the same strategy we use when looking to purchase new rental properties. This is going to allow us to determine whether this property meets our criteria to add to our rental portfolio. And most importantly, it's going to allow you to understand whether this property is going to be profitable or not. So different ways that you can look into buying a rental property. One of the things you're going to be looking at is your return on your cash, and this is cash on cash return. Another option that you can follow is based on appreciation. This is when the property is not necessarily making money at the time, but you're betting that this property is going to continue to increase, and then at some point you're going to be able to make some money as your mortgage stays the same, and over the years your rent is going to increase. Other benefits of investing in a property that's not making money is you're going to have tax incentives from the losses of this property. If you're a beginner investor, you want to be looking at cash flow for sure. Cash flow is going to be the way you're going to be able to make money on a monthly basis, and this is how you're going to be able to look into how you could create passive income in the future. So let's go to a scenario where we're buying a property and the property's value is $500,000. Now, in this scenario, you're also going to have a mortgage and you're going to be putting 20% down. So we're also going to run this scenario as if you were to buy the property cash, but for now let's start running it as if you're buying it with a mortgage. So your loan is $500,000, you're putting $100,000 down as a down payment, a 20% down payment, and you're going to have 1% of closing costs. This is going to be a total of $105,000. Now, the $105,000 is just including closing costs. This is not accounting for any other rehab or any other issues that might be in the property. So there are different ways that you could actually make more money from the property. So for this scenario, you're making only the $1,125 per unit, and that comes out to $4,500 a month or $54,000 a year. So now let's look into expenses. First, you have your taxes. In this scenario, let's just say it's $417 a month, and that's just 10% of the $500,000. Then you have your insurance, and let's just say it's $180 a month. Maintenance, we're going to have it $150 a month. Management fee is going to be 10% or $450 a month. Utilities, this includes sewer, water, or any other utilities that you might be paying as a landlord. And for this scenario, we're just going to say $250. So now let's calculate the mortgage. So the mortgage can be calculated at calculator.net. I included the calculator in the description, and here you're going to be able to see your monthly payment of $1,796 a month. Now your total expenses come out to $3,423 a month. And now all you're going to do is just calculate your cash flow. So you have your gross earnings minus your expenses, and that gives you your cash flow. So in this scenario, you have $4,500 minus $3,423. This gives you an earnings of $1,077 a month. That equals to $12,924 a year. Now, let's go into breaking down on how cash on cash returns work. So in this scenario, since we did get a mortgage, you're going to calculate how much money you invested in the property, which we did $105,000, and then your earnings, which is $12,924 a year. So you're going to divide the $12,924 by the $105,000 that you invested, and you're going to multiply that times 100, and that gives you your interest earnings, which is 12.31%. And if you think about it, the market usually gives you anywhere from 6 to 10%, especially lately might be giving you more, but historically it gives you 6%. So the fact that you're earning 12% gives you the incentive to actually get into real estate, because you're going to be doing a little more work than just putting your money in the stock market, and especially if you're managing the property yourself. Now, this is the thing about real estate. Remember that since you got a mortgage, your tenants are actually paying into the principal every single month. So one way that we could look into how much principal you earn through the year is we go back to the calculator and we scroll down and we see what's going to be the principal payment. So each month as you pay your mortgage, you're paying principal. So this principal is actually money that's actually going into your pocket, because your debt is going down every time you're paying your principal down. So if your mortgage was on $400,000, by the end of the year in this scenario, you paid $7,676 down on that mortgage. And this was paid by your tenants. So let's calculate that into your actual earnings as well. So if you calculate your principal payments of $7,676 plus your cash flow on a yearly basis of $12,924, that's $20,600 a year, and that equals to 19.62%. And that's 19.62% return on investment on your original investment of $105,000. So what happens when you don't have a mortgage and you buy the property all cash? You'll be all in at $505,000. It's a $500,000 of purchase and the $5,000 worth of closing costs. And now, since you don't have a mortgage, you're saving this $1,796. So when you do the $34,476 divided by $505,000 that you have all in the property, then you times that times 100, that gives you 6.83%, which is not terrible. It's a great return given the fact that you're earning 6.83% on your money, which is about the average of what you would get in the stock market. Plus, you also get tax incentives on all the expenses you have in the property on a yearly basis. And on top of that, you also have depreciation. So not only are you getting great return, but there's also other benefits of having a real estate property. So this is still a great investment given the fact that you can either go in all cash, depending on what your strategy is, or leveraging a mortgage and earning over 12% plus the tax incentives and depreciation that you get on a yearly basis. So in this deal, definitely buy something like this just because all the numbers make sense. So now for you, what you want to start doing is start practicing. So what you could do is you could start going into Zillow, you could start looking into listings and just run the numbers on multifamily. And one way you could do this is you're gonna know what the cost of the property is, put down the deposit of 20%, and you can use a mortgage calculator to do this, and then that's gonna give you the numbers of what your mortgage is gonna be. And then start looking at something like Zillow Rents to start looking at what the rental market is. And this is going to give you an idea of what you could get from rents in that area as well. So now you can start putting your numbers together, and the more you do this over and over again, the better you're going to get at learning to come up with a cash flow for the property. And this is going to be the key for you to start learning how to make money with rental property. So you got to learn the cash flow, and you got to learn what the numbers are before you start buying the property. Thank you for watching this video. If you have any questions, please comment below. Please like, please subscribe, and I'll see you guys in the next video.